So back then, I remember 2 to 3 years ago, I would pound on my chest and run a 1 or 2 stock portfolio, going all in, thinking that diversification is for idiots. Don't waste your time looking into so many companies. Go for sniper theory and 3 to 5x your capital. So I'm going to do 3 things in this video. Number 1, give you a brief overview and update on how I've been positioning my portfolio over the last 1 or 2 quarters. Number 2, how I think about portfolio allocation today. And number 3, what I intend to do for this new year of 2024. So I'm also going to answer whether I'm going to reallocate out of China because I'm quote-unquote scared, given that I've been at the brunt of this Chinese bear for more than 3 years now. Ready? Let's go. So I'm not gatekeeping anything. This is the latest breakdown of my portfolio, accurate as of 27th of January 2024. So for those of you that are more nosy, wanting to find out the exact amount and cost that I have for each individual position, you can actually reverse engineer the process. I've given the current value of my portfolio in the title of the video, the percentage weightage of each position, and a gain or loss they are currently sitting on. So if you're really that curious enough, go crunch the numbers yourself. Hint, use an Excel sheet. I think it'll be much easier. Now, let's talk a little bit about what I've been buying and selling over the last 3 to 4 months. Here's a quick breakdown. I don't have a special day dedicated to buy stocks, and I tend to just buy whenever I see value. But value is subjective anyway. Value is in the eyes of the beholder. So I've talked to a few friends before, and most of them have actually came to a similar conclusion. So I'm a rather boring person in general, and this includes my own portfolio and in finance. So there really isn't much action going on, and you can see that I tend to add to the same names that I already have in my portfolio, and I'm pretty much just buying in every day, every week, and every month. In the last 3 months, however, I did sell out of 2 specific positions, but more about them later on. So my logic is this. I believe that as long as you still have 10 to 15 years before your ideal retirement age, you will always be a net accumulator of stocks. So being net accumulators means that you will want the business to be sold as cheap as possible to you as you're accumulating, so that you can get the best bang for your buck. Ideally, after you finish accumulating, that's when the market suddenly realizes its value and the valuations will go to the moon, and you can then cash out for retirement. So of course, this is a pipe dream. So given that I have a relatively long time horizon, I want to accumulate a portfolio of really solid companies, and I try to do it as carefully as possible. So like any investment, the standard practice is DYODD. Do your own due diligence. So study the company, understand the business and its underlying economics, look through its financials, model out some assumptions and projections, and the last step is of course whether it's a good price today or not. Sadly, I'm not at the stage where I can go into a restaurant and buy anything off the menu without looking at the price. So sometimes I find it very hard to fathom how people can buy into stocks or shares of companies without looking at valuations. But maybe they're just that rich. Can something really be so good that it's worth any price? But that's another discussion altogether. So for myself at least, whenever I introduce a new company to the portfolio, I will always start with a starter position. So keep it right under 1%. Monitor it for a while, have skin in the game, look through their earnings, listen to what the management team has to say, continue to toy with the investment idea you came up with, and to constantly validate your thesis before allocating more position into it. So it's like a relationship. I need some time to get warmed up. So taking into account reality, most of us probably have a job and a paycheck coming in every month. So adding to the position is natural as you contribute more to your portfolio over time. So I've did this very interesting exercise where I tabulated the number of days that I've held each company in my portfolio, counting them from the first date of the purchase itself. So you can see in general, those that occupy a larger percentage that tops the list tend to be very early buys that was built over time. So it's definitely a stark contrast compared to some of the research platforms saying that the layman investor actually don't hold their positions for a very long time. So I don't think I'm the type that is comfortable allocating a large part of my portfolio to a new idea that will promise to bring me to the moon as soon as possible. And also because of this very nature of me being very slow to move, My portfolio turnover is actually quite low, and I tend to not kick out companies so easily or so frequently, basically giving them some sort of a second chance to turn over a new leaf. This might also explain why I'm stuck back holding Baba for so long. But that said, I've recently kicked out two companies, Estee Lauder and Suntec REIT. So I've recently received my cash vouchers of $120 from participating in the previous MoneyBoo campaign. And I'm happy to share that Webull has decided to extend this MoneyBoo campaign until the end of January. So for those of you who initially missed it, now is the time. But before that, some of you might be wondering, why bother? So here's the thing. The world has recently been bitten by high rates of inflation, but sadly, salaries are not keeping up as quickly. So most of you probably already know that you need to invest so that your money works harder for you. Yet at the same time, you want to also take advantage of the high interest rate environment as well. And personally, I've been contributing to MoneyBoo instead. So MoneyBoo is a wealth management tool offered by Webull, and without a lock-in period, MoneyBoo helps you earn a yield by investing your idle cash into an underlying cash fund. So based on the 7 days USD yield, they've delivered around a yield of 5.4% per annum. You can now subscribe to MoneyBoo and start earning yield on your cash while maintaining its liquidity. So the MoneyBoo's underlying cash funds are portfolios consisting of short-term and low-risk debt securities. But although it is low risk, it does not mean that it is risk-free, so don't mix them up. Here's the best thing though, since the money is not locked up, you are able to quickly deploy the cash elsewhere, especially so if we experience a flash crash of some sort if Mr. Market decides to go on tilt for whatever reasons. So on top of earning a yield on your idle cash, the current MoneyBoo campaign allows for users to get bonus cash vouchers worth up to US $3,000 if you fulfill the qualification criteria. So you just have to fulfill these two key steps. First, tap on participate now and complete an initial funding of any amount during the campaign period. Second, subscribe to MoneyBoo and maintain the net cumulative deposit amount until the stipulated event period. And you will be able to enjoy cash vouchers worth between 80 to 3,000 US dollars. So it has never been easier. Also, did I mention that Webull is running a new user sign-up campaign until the end of this month, where new users using my link down below can now create, fund, and maintain any amount to receive 5 free shares worth between US $3 to $500. Furthermore, if you subscribe to at least $500 US dollars in MoneyBoo and maintain it for 30 days, you get an additional 20 free shares worth between US $3 to $500. And for those of you who want to invest for the long term and don't want to sweat it managing too much of your positions, you can now also automate your investments via Webull's regular savings plan. So Webull's RSP currently supports US listed stocks, ETF, and SGD USD mutual funds. So new year, new me, and sign up for a Webull account with the link below. Thank you Webull for sponsoring this video. So I've previously made a video on Estee Lauder. My current thoughts actually didn't change much. It's a turnaround play, and they're currently grappling with a few key challenges, mainly China and their new distribution network. So I've rewatched the video, and I did sound a little skeptical about the pace of recovery and how management team has been blaming everything under the sun, and it's not necessarily the business fault. Additionally, I was pitched an idea by a friend, and they happen to be in the same industry. Therefore, I decided to bite the bullet and switched out of my Estee Lauder position to LVMH instead. So my initial thought process was to have a luxury and cosmetic exposure, and I think this switch is in line with my objective. Of course, I've also came to realize after studying the company that LV is a lot more higher in quality and it's not trading at a very demanding valuations as well. So that's how things essentially transpired. So on the other hand, regarding Suntec REIT, I still like the assets that they own, but not so much the balance sheet and the gearing in general. So I realized the initial thesis of the tapering interest rates might not come into fruition as quickly as everyone expects. Therefore, I actually didn't want it to be caught off guard in the worst case scenario, essentially trying to hedge or protect my downside. So my personal opinion, there are a lot of strong REIT contenders in the Singapore market today. So I'm just going to place much more emphasis and focus on the strong ones and not be too calculative, or some might say too blinded by their valuations. and buy just because they are very cheap. So I've switched out of my Suntec exposure with Fraser's Centrepoint Trust. And they recently announced that they wanted to acquire Next, which will probably stack up their gearing again. So funnily enough, I'm going one whole round. Leverage is a problem that I cannot run away from, especially when you're investing into properties. But I do think that Fraser's is in a much stronger position. And I'm currently still monitoring, and I might add to my REITs exposure as and when I see the market punishes them. So the second part of the discussion is how I look at portfolio allocation now. So I think it's been a very fulfilling self-discovery journey, understanding myself bit by bit every day more as we go through life. So back then, I remember 2 to 3 years ago, I would pound on my chest and run a 1 or 2 stock portfolio, going all in, thinking that diversification is for idiots. Don't waste your time looking into so many companies. Go for sniper theory and 3 to 5x your capital before moving on to the next big idea and compound your money again. So I'm not saying that strategy won't work, but I guess as time flew by, I had a deeper appreciation of what the conventional notion of diversification mean, especially with more capital under my belt. So as the capital grew, and if I stuck to my guns and run a one-stock portfolio, I can lose my annual income in a matter of few days. Especially if the stock is very narrative and news-driven, that creates a lot of volatility around it. However, I'm also careful with the fact that I don't want to diversify for the sake of it, resulting in this term called diversification. Personally, after some time, I do believe that jungle is huge, and it is not a marriage where I'm stuck with just one tree. Owning a basket of high quality businesses is the end goal. And due to the nature of the stock market, there are many high quality businesses that are listed. And because it's an auction based mechanism, I wish to take advantage of the euphoria and pessimism. And I will go overweight on opportunities that I think offer outsized risk reward. Which comes back to the point, am I scared of China today? So I believe most people already have the impression that I'm a very big Chinese bull. So I mean, it's reflective based on my portfolio, right? Around 67% of my portfolio is allocated to Chinese names today. So for regular viewers, you probably have heard of this before, where I was sharing that I'm basically trying to rebalance my portfolio by adding new funds into other non-Chinese names. So I then get people bouncing back saying that, oh, Chee Keng, you have lost your way. You have lost your conviction. Why are you not buying into China, especially when it's at dirt cheap valuations, etc., etc. So the funny thing is, I'm not even selling anything. I'm not balancing in a conventional active way by selling China and buying into other names. So that's active rebalancing. Today, if I'm managing a multi-million dollar portfolio and have inflows that I know won't move the needle, then yes, I will actively rebalance given that my portfolio is very concentrated and top heavy. However, given my own circumstances, I'm running a portfolio that is still manageable, and the new monies coming in can make an impact to the allocation. So if it's thesis breaking, like if China lost its way or the management team of the companies that I own lost their way, then yes, I would sell tomorrow. But for now, I do still see a great deal of value in many of the names that I hold in the portfolio. I mean intuitively, if not, why would I be holding them? So why would I be in a rush to sell them quickly to just reallocate? So some might ask, what am I intending to do from here on? So I'm not going to lie. Considering that the US market in general has ran up quite a fair bit, I'm always very, very tempted to add to my Chinese positions just because they look too compelling for me to resist when comparing to other alternatives like their Europe and US counterparts. However, at least on a portfolio level, I would still like to bring it down closer to parity, at least 50-50. 50 Chinese, 50 non-Chinese. So I still have a long way to go, but if I continue adding to other positions and the Chinese names stays beaten down, I think I'll reach there quite quickly. So on a similar note, if China decides to recover and it becomes very Chinese heavy again, then it's a happy problem that warrants a different discussion. That said, I'm still quite sensitive to valuations, and I'll hold back from buying if I think it's not worth it. So for 2024, the plan is simple. For baseline, I'm going to kickstart a DCA plan, which is a dollar cost averaging plan, into a broad-based index fund. So since US indexes are breaking all-time highs, I'm separately preparing dry powder to potentially exercise a different strategy called the enhanced DCA if the market decides to tank. So on a baseline, there is that normal DCA, and then on an enhanced DCA, it means that, for example, for every 10 to 15% the market goes down, I'll increase the DCA amount by 50%. So in order for me to do that, I have to start at a low DCA base. So that's something I'll prepare for. So that's for the passive approach. On a much more active front, I will still have a sum of money set aside for my own allocation to names that I wish to add to my portfolio. And the goal this year is to continue buying good companies at fair valuations. In the longer term, it's the same. I want a portfolio of solid companies. What will you do in 2024? With that, I'll see you in the next video, but more importantly, and hopefully, I'll see you on the moon. Goodbye.